Hi, good morning, everyone. Thank you so much for joining our Phillip Security Research 11 o'clock Monday morning call. Today we have a couple of macro sector update, including Singapore Construction Quarterly, Singapore Weekly, and also Phillip macro update. In addition, we also have a result for US tech company, Sheng, and also update of Keppel, Suntec REIT, and also CapitaLand Ascott Trust. For Phillip on the ground, we have Wilma, Mapletree Logistic Trust, as well as our technical pause. For disclaimer, this information provided in this seminar is actually solely for educational purposes and it should not be considered as a financial advice. So please seek advice from a financial advisor before making any investment decision. So next, I'll start the presentation with meta results. So overall, the result actually exceeded our expectation, with the revenue actually up 26% year-on-year to 51.2 billion, and the adjusted PATMI actually increased 19% year-on-year to 18.6 billion from a very strong ad revenue growth. So the ad revenue growth actually remained very strong at 26% year-on-year. This is driven by a better user engagement and also improved ad efficiency. So users are now actually spending more time on family of apps, especially threads. So the time spent in this particular platform actually increased 10% year-on-year because of a better recommendation and ranking optimization system. Advertiser demand actually still remain very strong, with the average ad price actually increased 10% year-on-year. Video is also becoming a very key point to drive the growth. So as Instagram video time spent actually up 30% year-on-year, and Reels now actually is reaching a annual run rate of $50 billion. As for the other revenue, this business segment actually grew 59% year-on-year, driven by WhatsApp pay messaging and also Meta verified subscription. Business messaging is actually showing quite momentum because the click to WhatsApp revenue actually grew over 60% year-on-year in the third quarter. And moving forward, Meta actually will roll out to expect that the rollout of ads on WhatsApp status to be complete by next year. In terms of the negative, the Reality Lab continued to be unprofitable with the operating margin of $4.4 billion, but the revenue actually grew 74% year-on-year this quarter because of a strong AI glasses revenue. And also the retail partner actually starting to stock up the Quest headset moving into the holiday season. And in terms of the outlook, Meta actually expect the revenue growth of 16% to 22% in the fourth quarter. The company also expect the expenses to rise around 22 to 24% this year because of a high infrastructure cost, including cloud and also depreciation expenses, and also a very expensive AI talent compensation. So in terms of the CapEx, the company actually increased the bottom end of the financial 25 CapEx guidance by $4 billion to 70 billion. Between 70 and $72 billion. Based on the number, it actually implies the CapEx year-on-year growth is around 190% in order to support the ongoing AI infrastructure expansion. For financial year 26, in the last earnings call, Meta actually mentions that financial year 26 CapEx dollar growth will actually be at a similar pace like financial year 25. But now the company actually expect CapEx and OpEx to increase quite significantly in terms of the dollar growth in financial year 26 than this year. So now we actually estimate a bottom end of financial year 26 CapEx to exceed $100 billion. So moving forward, we do expect more deals from Meta with cloud services provider, and we actually think it's necessary to enhance the AI capability, but we do expect some pressure on margin on the short-term basis because we do think this partnership actually will lead to a higher third-party cloud services expenses, alongside with depreciation expenses from Meta on AI infrastructure, which currently they serve only for the internal usage and does not really generate any revenue from the external. We are also slightly cautious about Meta spending momentum because in this earnings call, they didn't really provide a very clear roadmap about how to monetize, a more detailed monetization roadmap. So, but we do believe the overall investment size remain reasonable at this moment, considering the very intense AI competition landscape. And also, if you look at the result, Meta still attain a very strong monetization power through the existing product offering. So we maintain an accumulate rating for Meta, but we actually reduced the target price from $830 to $770. We actually keep the revenue forecast unchanged, but we do increase the financial year 25 PATMI by 14%, around 40%. 14%, sorry, because of the lower than expected non-research and development expenses. And at the same time, we also reduced the terminal growth rate to 5.4% to reflect the impact of Meta very significant commitment in growing super intelligent labs. Next, for Alphabet, yeah. The revenue and PATMI actually were within our expectation, with the revenue actually surpassed $100 billion for the first time, with a 16% year-on-year growth, and PATMI actually increased 33% year-on-year. We continue to see a very strong search and YouTube ad performance. Both of them actually grew 15% year-on-year. Monetization in Shorts also continue to be improving because users now actually have a longer watch time. Because Alphabet actually leveraged Gemini in their recommendation system. So Shorts are actually now generating more revenue per watch hour than the traditional in-stream YouTube. And the cloud business segment actually continue to be the fastest growing segment and continue to show very strong monetization power. So this business segment actually grew 34% year-on-year because of three reasons. The first one is because of very strong performance in GCP. The demand for AI product from enterprises are very strong, and the client base keep expanding at the 34% quarter-over-quarter basis. And the secondly is because there are more larger deals signed, with the number of deals actually worth over $1 billion signed year to date, actually surpassed the previous 2 years combined. And the third reason is because they do have a deeper client relationship with the existing cloud clients. So now that like 70% of them actually adopting Alphabet Gen AI products such as Gemini and Imagen. So the company actually mentions that the revenue from product built from Alphabet generative AI model actually grew 200% year-on-year. But Alphabet actually expect a very tight supply condition going into financial year 26, and the backlog actually grew 82% year-on-year to $155 billion. In terms of margin, overall margin actually increased 1.5% to 33.9%, while the cloud segment actually delivered a very significant operating margin. The cloud margin actually rose 6.6% to 23.7%. This is actually supported by a very strong revenue growth and also the expense base efficiency. We do expect a further margin expansion because as Alphabet continue to scale the very diversified revenue stream, and we actually believe that the company actually have greater flexibility in managing costs because of the differentiated product actually developed by its own technology. And for the negative, Google actually increased the CapEx guidance by 8% to a range of $91 billion to $93 billion. We do expect the surge in CapEx might weigh on the valuation in the short-term basis because of the very high depreciation expenses and also energy-related expenses, which in this quarter is reported an increase of 41% year-on-year. But we do think that the impact could be offset by a very strong revenue growth in core advertising and cloud business. And at the same time, this company is still very cash rich. So, and we see that the free cash flow position actually grew 39% year-on-year, despite there are a lot of ongoing heavy AI spending. We think that the investment size remain reasonable as well, given that Alphabet actually has the capability to monetize a product, and at the same time, we think that it's essential to scale cloud and Gemini development. And then overall in this earnings call, we actually see more Alphabet capability to leverage its AI technology. So the Gemini integration into search actually has proven to enhance the user engagement, because queries wise, AI overview queries actually grew more than 10%, and AI mode query actually doubled since the second quarter. So their very sticky behavior remains in Google's massive user base. And then in terms of the pay click, when it comes to the key metrics, which these metrics actually represent the ad engagement by the user, actually grew like 7% year on year in the third quarter. We think that it can be an indication that there is a very good improvement in Google ad targeting capabilities. And we also believe the resilience of percent year-on-year growth in cost per click actually shows the advertiser demands continue to be strong. And it also helps to ease a little bit of the concerns that the AI summary actually reduce the website traffic and weakens the advertising returns. And lastly, Alphabet AI model currently process around 20 times more tokens than 1 year ago. We think that is also an indicator of a very strong adoption from both consumer and also enterprises. So for Alphabet, we actually upgraded our rating to buy and raised our DCF target price to $340 from $265 because of Google expanding monetization potential as a full stack AI provider. We actually increased the financial year 2025 revenue forecast by around 2%, and increased the terminal growth rate to 5.5% from 5%, to reflect Alphabet's very strong fundamental and the product differentiation. And that's all from me. I'll pass the time to Glenn. Thanks very much.
Hey, thanks, Serena. Yeah, so I'll be covering Tesla. They released their results about a week ago. Yeah, next slide, please. Yeah, so the main point of this for Tesla's recent results, the third quarter results, was that their deliveries finally improved year on year. Quarterly deliveries hit a record high, and this is all due to from the EV tax credit removal, which was gone on the 30th of September. So a lot of customers actually rushed in to buy a EV car because they want to make use of this $7,500 EV tax credit. So third quarter results came in slightly above our expectations, with the 9-month revenue and adjusted PATMI at 80% and 78% of our forecast, mainly driven by these higher than expected deliveries. But then again, if you look at their baseline, the PATMI was actually lower by 29%, really because from lower margins from the higher average cost per vehicle, and also lower regulatory credit revenue and higher OPEX. For the positives, the main positive being that they have record quarterly auto deliveries from this, and it also grew. If you look at a year-on-year basis, the third quarter deliveries grew by 7.5%, the highest year-on-year growth in 7 quarters, so in more than 2 years. And this came from the customers all rushing in to buy a car, EV car, before the expiry of this $7,500 credit. So it's not just Tesla, that benefited from this. All the EV makers in the US actually benefited from this. So we saw car sales, EV car sales actually increase across the board. But what we believe is that this will fall off in the fourth quarter onwards, because firstly, the EV tax credit will be gone, the $7,500. And also, it's a bit of a double whammy, because now that this is gone, Tesla will need to lower their cost of the car in order to compete. So in order to attract more customers. So this will also lower their average selling prices, or ASP, and then this will in turn lower their margins as well. If you look at China-wise, where they won't have this tax credit thing, right? Tesla is still continuing to struggle, right? It has fallen. Their domestic sales in the third quarter has fallen by 7%, despite the overall China EV market actually growing by 26%. They're also continuing to lose market share to BYD, which is still the largest player. Yeah, so in China and in Europe, they're actually not doing as well. The other positive is that their non-auto revenue has continued to surge. So both the services revenue, which supplies the supercharging, as well as the energy generation and storage revenue, has continued to improve, mainly from new products that they have released, and also continuing demand. But then again, it makes up a very small portion of their total revenue. The only total non-auto revenue only makes up around 1/4 of their total revenue. So Tesla still is very dependent on car sales. As for the negatives, quite a few, margins have continued to decline. So although their deliveries have increased and reached a new high, but margins have declined by 185 basis points, really from the higher average cost per vehicle, mainly due to the lower fixed cost absorption for specific models, as well as an increase in tariffs and the sales mix. So they are releasing also a few budget models, which is why there is this lower average selling, lower margins. Also higher operating expenses from their AI and R&D projects, and lower regulatory credit revenue. Their ASPs were also flat. So we estimate that their average selling prices were basically flat this quarter, which is an improvement if you think about it, because for the last 10 quarters they were declining. And the revenue per vehicle also remained relatively stable after 10 straight quarters of decline. But what will happen is that we believe in the next quarters and next few years is that they, in order to compete with the other new EV players in the US and also in other countries like China and Europe, they will have to lower their cost of their cars, which is they came out with this budget Model Y, and then this will also further lower their ASPs. So for the outlook wise, we believe that the removal of this EV tax credit, the lowering of emission standards, and also the tariffs on China could further lower Tesla's demand and margins. And the ongoing competition from all the Chinese EV makers and also those that they have in their home country in the US will also weigh on their volume and prices, where they will have to compete on prices and will continuously have to reduce their ASPs. And the big talk about this last earnings call was the robo-taxi, full self-driving, and the Optimus robot. But all these, they are sort of like, Elon Musk's pipe dream, right? It hasn't come true yet. They haven't even rolled out or made any retail sales yet, right? It's still they haven't started production. So we believe that all this is still quite far out to even contribute significantly to revenue at all. Best case is 3 to 5 years out, but I think a very safe guess would be more like 5 to 10 years. So and all this will not contribute significantly to revenue anytime soon. And also the steep valuations of 250 times PE has already suggested that all these robot and full self-driving has already been priced in. So we do maintain a sell with an unchanged target price of $220. So that's all I have for Tesla, and I hand it over to Helena. Thanks.
Thank you, Glenn. So I continue with Amazon. So it's a pretty positive quarter for Amazon. Their AWS growth starts accelerating. So taking a look at their results, their third quarter revenue and adjusted PATMI were in line with our expectation. If you look at their 9 months FY25 revenue and adjusted PATMI, it's around 70%, 79% of our FY25 forecast. So revenue grew 13% year on year. The primary driver was AWS, which grew 20% year on year, and also advertising, which grew 24% year on year. The operating margin compressed slightly because AWS margin compressed due to heavy AI investment, and retail margin also compressed because they have a one-off 1.8 billion severance cost and also another 2.5 billion legal settlement charge. So if you actually ignore these one-time charges, their retail margin actually expanded. So moving on to the positive, the first is their AWS has been reaccelerating. So the third quarter FY25 revenue grew 20% year on year, which is the fastest growth in the 11th quarter. So this is up from the 17.5% last quarter and 16.9% in the quarter beforehand. So that signals a very clear reacceleration in the growth as their investment really starts to begin translating into tangible results. AWS has been focusing on expanding their capacity. They say they have doubled its power capacity since 2022, and they're remaining on track to double it again by 2027. Their capex stayed very elevated at $34 billion for the quarter, and it's expected to rise further in 2026. Meanwhile, if we take a look at their demand, it's still very robust demand. AWS mentioned their backlog actually climbed to $200 billion in the third quarter. So to put that into perspective, that exceeds the cumulative deal order of all the AWS revenue recorded in the past third quarter. So all these revenue combined, they're not as much as the backlog that they're seeing in the third quarter. So that kind of shows there's a huge amount of demand coming in. So second positive point, it's something that we always like. We think advertising is still a spotlight for Amazon. So advertising revenue this quarter it grew 23% year on year. It's also the fastest growth in the 6 quarters. It's driven by the expansion of its demand side platform called the Amazon DSP, and also they're having a series of partnership with different companies like Netflix, Roku, Spotify. So all these have significantly broadened Amazon's reach, giving their advertiser the more direct access to a variety of audience across video, audio, and live content platforms. So we view this as one of Amazon's very long-term growth drivers, given its ability to scale alongside the company's retail ecosystem. Advertising still contributes to a very small part of the revenue, around 10% right now, compared to 1 year ago, it was only 9%. Moving on to the negative is their free cash flow has been compressed due to significant investment in AI. So if you take a look at their trailing 12 months free cash flow, it was down 42% year on year. And the decline was primarily a reflection of their heavy investment in AI infrastructure rather than a weaker operation. So this does align with the typical data center scale dynamic. You need substantial upfront spending before it start yielding result and expanding margin. Moving on to guidance, they have guided the fourth quarter revenue to be between 10 to 13% year-on-year growth. Operating income for the next quarter is expected to be between 21 to 26 billion compared to the 21.2 billion 1 year ago. And their capex is expected to remain around the same. It's going to be 35 billion US dollar for the next quarter, but they do expect it to increase again in FY26. We think overall Amazon's outlook remains strong. AWS is reaccelerating, and advertising is also increasing very fast, both benefiting from the rising demand and strategic partnerships. Even though their free cash flow fell due to their heavy AI spending, we view this as a long-term investment phase rather than a weakness. And the reacceleration of AWS already showing a positive sign that such investment is slowly paying off and translating into revenue. So overall, we think the fundamentals stay solid. We see no material concern as long as free cash flow remain positive. As for the valuation, we increased our FY25 revenue by 1% and PATMI by 6% to account for the growing demand in AWS, as well as the continued cost discipline effort that they have in their retail segment. We increased our DCF target price to $290 from the previous $260, but we do downgrade our recommendation from buy to accumulate due to recent price rally. So that's all from me. I'll pass my time to my colleague.
Yeah, so moving on to class, so just a third quarter business update. Yeah, so they've indicated that they are committed to maintaining stable distributions or dividends at 6.1 cents for this year, FY25 as well as 2026. Yeah, so for the just some quick highlights, there were very little financials provided. It's just a business update. So the gross profit was up 1% year on year due to the portfolio reconstitution efforts. Yeah, for the RevPAR wise, most key markets they registered year on year RevPAR growth on the same store basis. So you take a look at the bottom right chart, you see Japan is down 23%, but that is not on the same store basis. That is because they acquired a budget hotel. So that because of the acquisition, the RevPAR is lower as the ADRs are lower. But on the same store basis, the Japan RevPAR is up 7% or so. So basically all on the same store basis, all the geographies were positive except for Singapore. So that is due to the fact that mainly because of F1. So usually F1 Singapore visitor arrivals will be about 150K. So because F1 was in October this year as compared to September last year, so as a result, the Singapore RevPAR is down 2%. But this 2% year-on-year decline is actually better than we expected. We originally anticipated it to be weaker. Yeah, so that is a positive. And yeah, for RevPAR during this Singapore period, yeah, a lot of the companies already mentioned that the RevPAR during this F1 just a few days year on year, like this year's RevPAR during the F1 period compared to last year's RevPAR during the F1 period is already about 20% higher. Yeah, so things are looking quite good. Yep. So other than that, for them, the occupancy during this quarter, third quarter was at 83%. So this was an increase from 3Q 2024, 79%. So mainly was higher occupancy that drove this RevPAR increase. Yeah, so for their financial position, the cost of debt remains stable at 2.9%. So we expect it to remain similar in the fourth quarter around these levels. gearing 39%, yeah, expected to decline when they use the proceeds from the completed divestment of Citadine Central Shinjuku, Tokyo. If you remember, in the third quarter, they divested this asset at 100% premium to book value. Yeah, so they unlocked about 50 million of net divestment gains from that asset. Yeah, so gearing will decline once they use these proceeds to pay off some debt. Yeah, and for the negatives, this quarter we noted that there was some weaker performance in the US PBSA, but only slightly weaker performance. This mainly because of increased supply in some of the sub-markets or some of the certain markets that they are in. So the rents was down like 0.9% year on year. Occupancy was also slightly lower. Another thing to note is that the MPM margins were also lower, mainly because they had more marketing expenses, marketing costs to try to attract more students into their PBSAs. Yeah, because of the new supply, there was more competition. Yeah, so going forward next year, so we expect some higher marketing costs to attract the students in. Yeah, and regarding the uncertainty over visa policy, they are relatively less affected as 90% of their tenants are local and only 10% are overseas students. Yeah, so they are relatively less impacted by that. Yeah, so for the outlook and AEIs for them, they have 5 projects upcoming. The biggest one is just slip my mind. Just slip my mind what the asset was. The Cavendish London. Yeah, so that asset is the biggest one. It was originally scheduled to begin this year, but they pushed it back next year so that they can at least maintain the stable DPU. So they mentioned that they will adjust this schedule accordingly to macro conditions and renovation costs. Yeah, so in a situation where the core DPU is unable to hit that stable DPU that they mentioned, they'll use the previous divestment gains to top that up to 6.1 cents. So we are certain that this year, next year, the dividend yield will remain around 6.4%. Yeah, and for acquisition wise, they are continuing to explore acquisitions in developed markets, Australia and Japan and UK, with a focus on the living sector in Japan, as that will form the stable base that they are looking to pivot towards. Yeah, the living sector. Yeah, and they also have, like I mentioned, 350 million in undistributed divestment gains that are still sitting on the balance sheet. So yeah, they are free to deploy that as and when, but they're holding back for now, only using that to top it up, top DPU up to remain stable. Yeah, so with that, we just downgrade to an accumulate due to the recent share price performance. No change to our target price, and we are paying an attractive yield for CapitaLand in 6.4%. Yeah, next slide, please. Yeah, so an update on Suntec REIT. The low hedge ratio will support DPU growth going forward. Our hedge ratio is 66%. They target around 60% hedge ratio. Yeah, so for the third quarter, just some quick updates. The Singapore performance was stronger. It was offset by some vacancies in Australia and UK. But for DPU wise, it was up 12.5%. Just mainly due to lower financing costs, 6 million lower, as well as the reversal of tax provisions due to the Australian properties getting the MIT status. So they reversed back the tax back out 2 million this quarter and another 2 million expected in fourth quarter. So if you strip out this reversal of tax, the DPU would have grown about 8% regardless. Yeah, so for the positive, it was a strong performance in Singapore. Retail reversions ranked at 8.5% for the third quarter. In Singapore, it did slow from the double digit in first half, but going forward, we expect around around high single digit retail rent reversion. For office, 8.6% rental reversion. Also, we also expect it to remain on these levels. For Suntec City Office, we expect slightly lower positive rent reversions because the expiring leases are really closer to market, while the MBFC and ORQ, those leases are still a bit off from market rent. So as they renew those leases, the potential for higher rent reversions is there. So for that, we're expecting like double digit. So if you net that off, roughly around high single digit positive rent reversion for office. Yeah, so their financing cost has really declined quite significantly, 44 basis points year on year decline. So now it's at 3.62%. Like I mentioned, their hedge ratio is quite low, 66% only, lower than the average of the most S REITs. Their gearing also is stable at 41%, likely to increase, or rather it will increase slightly to perhaps around 42%. When after they repaid or rather they redeemed the perps that was due for call in October last month only. Yeah, just last week. Yeah, so for the negatives, the overseas portfolio remains a drag, like the Australian and UK. There's still some occupancy, still some vacancies. Like the weakest asset is 55 Curry Street, so occupancy 51%. They are in there are 2 leases that are close to being signed or being confirmed, so that will likely bring occupancy to 66% by year end. There is potential, like there is interest to bring it up all the way to 88%, but that is in a very optimistic case. So probably likely base case, this 55 Curry Street will be 66% leased up by year end. The Minster building also right now 85.4% occupancy, so that remains kind of a drag with that about 50% vacancy. Yeah, so for Suntec REIT, continuing to have that target of 100 million in divestment from the Suntec City Strata office. So year to date, that is quite slow. They indicated some plans that they would like to divest some 1 or 2 Australian assets, as that is not performing too great, and like the tenant incentives are still 40 to 50%. Yeah, so there is still some weakness in Australia, and yeah, but for Suntec REIT going forward, the growth will really come from the low percentage of interest rates of debt that are on fixed rates. So that is only 60%. So they'll really benefit from the very low 3-month SORA. So that will help to support DPU growth as we've seen in the third quarter. Yeah, so similarly to class, we downgrade to accumulate, but that's mainly from the share price performance as REITs really rallied over the past few months. So we have a higher target price of 140 as well. So previously it was 136. So Suntec actually traded about 40% discount to NAV and traded about 5.7% yield. Yeah, next slide, please. Here's a quick update on Phillip on the ground on MLT's results. So MLT, they issued their second half results. So we see DPU was down 10%, but we strip out the divestment gains. It's down lower by about 4.8% because in FY, like the previous year, there was about 6 million divestment distribution from divestment gains top up. Yeah, so if you look at second quarter numbers, they're mainly impacted by FX. So as well as absence of contribution from divested assets, but it's partially offset by the completion of the Mapletree Joo Koon logistics hub, as well as higher rent reversions in Singapore especially. So if you exclude FX, the revenue and MPI is down 0.9% and 1%. So it's much lesser than the amount you see on top there, like 3%. Now for them, cost of debt declined to 2.6%. So that's mainly from the lower 3-month SORA as well. And gearing is for 1.1%. So they do hedge 75% of their FX into Sing dollar. So that mitigates a bit of FX risk. Yeah, so for their portfolio occupancies at 96.1%, one thing to note is that the China occupancy improved 1 percentage point to 94%. So basically that was from 93%. So going forward, they indicated that they are optimistic that they can increase this occupancy to higher. But right now, we noted that the rent reversions are also they're becoming less negative. So we see as a portfolio, the rent reversion was 0.6%. If you exclude China, it's 2.5%, but China this quarter was just minus 3%. So this is a huge improvement from last quarter, minus 7.5%, and a year ago, minus 12.2%. So this mainly from the fact that a lot of these Chinese leases, they are on short-term leases. So a lot of them have already been marked to market. So going forward, the leases in China has likely close to bottom or already bottom. So we're expecting like by end of this year, like the calendar year, it's likely that rental reversions will start to become flat for China, or very low single digit negative. Yeah, so they do have about 500 million in the investment pipeline that they are looking to divest in Greater China. So by this financial year, they're expecting, or rather they hope to have 100 million in China in divestments. Yeah, so yeah, like for the outlook, like I mentioned, China negative rents likely to moderate, so likely neutral, and at the same time, the occupancy is also likely to improve in China especially. Yeah. So now remaining only 10% of Chinese leases that have yet to be marked to market. So for Singapore rent reversions, after many quarters of like double-digit rent reversion, now it's starting to slow. So we're seeing low single-digit rent reversion outlook. And for them, a tariff impact not so much. They're only about 5% or less of their portfolio is exposed to the US. So based on the FY25, or rather the second quarter DPU, if you annualize it, the dividend yield will be 5.4%. Yeah, so that's the update from me. I'll hand over time now to Ekman. Thanks. Oh, sorry, to Ziyi. Thanks.
Yeah, thank you, Darren. Good morning, everyone. Today I will share, next slide, please. Today I will share a quick macro updates focusing on the latest October FOMC meeting, which took place on 29th of October. The key takeaway is that the Fed cut rates by 25 basis points to 3.75 to 4% and announced it will halt balance sheet runoff starting 1st of December 2025. So this marked a cautious but mildly dovish shift in policy directions. The decisions came with a split vote of 10-2, with Stephen Miriam push for a 50 bps cut, while Jeffrey Smith preferred no change. So Jerome Powell made it clear that another rate cut in December is not a foregone conclusion, which showed that Fed remained data dependent, wanting to see how inflation and labor market evolve before committing to further easing. So ending EQ mean that Fed will reinvest maturing agency debt into treasury bills, signaling a tilt towards shorter date holding, which effectively slowing the pace of balance sheet tightening. So Jerome Powell also noted that labor conditions are cooling, job gains have slowed, and unemployment has edged up slightly, but still remain low overall. And at the same time, inflation remains sticky, especially in goods categories impacted by tariff. So he mentioned that these tariff-related price pressures are likely temporary, but he added that data delay from US government shutdown has increased policy uncertainty. Overall, the Fed recognized the downside risk to employment are rising, even as inflation remains somewhat above target 2%. And looking ahead, the Fed now appear to be in a hold and assess phase, balancing softer labor momentum against still elevated price. So market are now watching the December summary of economic projections, which should give more clarity on the next policy step. That's all from me. Thank you. I will pass the time now to Ivan.
Thanks, Ziyi. Yep. Now I'll be presenting on construction quarterly. We just started this to give some insights into the construction sector. Yeah, next slide, please. Yeah, so I tried to categorize the construction companies into three different categories for companies with the same financial year. So as you can see in the top table, general constructions are companies building on buildings, warehouses, MRT stations, etc. Heavy lift companies are basically crane companies, working on projects involving cranes. Infrastructure companies are companies working on tunnels, buildings, tunnel bridges, and roads. For example, OKP and Hock Lane Seng. Yeah, so if we look on the left side, the overall revenue increased by 16% year on year. So this is the highest increase since first half 2022, and the cost increased by a lower growth rate as compared to revenue. So we see increasing margins, which I will touch on very soon. We do think that this kind of trend will continue going forward. As you can see in the bottom left-hand corner chart, all three categories, their revenue are increasing. We do think that this will continue going forward because of more construction contracts being awarded. For example, there's higher number of private industrial contracts being awarded, which will benefit companies like Soybuild. And infrastructure-wise, there's more projects involving North-South corridor. So this will positively benefit the infrastructure projects companies. And I think in general, with the expansion of LTA, MRT lines, and HDB BTOs, this will also benefit the heavy lift companies. Yeah, so within these three categories itself, general construction's revenue increased the most at 20% because of Soybuild 77% increase from high value project completions. And we do think that because of Soybuild's $1.2 billion was the order book, this gives them more visibility also going forward. We do think that this trend will continue because of the huge Tuas Port project that they are currently executing. Going on to margins on the right hand side, you can see that the margins of heavy lift and infrastructure companies are stable at about 10 to 20%. Whereas for general construction, it is about 5%, but it is at the highest in the past 5 years because they have completed the low margins COVID projects. And this is the same for all three categories. So their margins are above the 5-year historical averages. And for general construction, we do think that their margins will continue expanding because of the higher tender margins that they can get from higher tender prices, which I will explain more in the next slide. Yeah, next slide, please. Yeah, as you can see on the chart on the left-hand side, the tender prices have risen by about 6% compounded annual growth rate. This means that when construction companies bid for contracts itself, the price that they are able to secure is able to, the margins itself is able to increase from there. Yeah, so this contributes directly to their bottom line. And for the chart on the right-hand side, you can see that ready-mix concrete demand has increased by 10% year on year in August itself. So this is the highest increase since July. And we do think that this higher ready-mix concrete volume will benefit Pan United because Pan United has a 40% market share in ready-mix concrete. So we do think that Pan United's second half results will definitely, is able to benefit from this trend. Yeah, next slide, please. Yeah, so looking at construction material prices, on the left-hand side, steel rebar prices are still falling. So it has fallen 13% year on year in September, whereas ready-mix concrete prices has remained stable. So we do think that the falling steel rebar prices will impact BRC Asia's results because it will offset the amount of revenue that BRC Asia can achieve in the second half of this year itself. However, we do think that this is kind of a double-edged sword because steel rebar is also BRC Asia's raw material. So this also supports their bottom line margins. As for our planned industrial space, the chart on the right-hand side, as you can see, the planned industrial space in the red color line sort of leads the amount of industrial space under construction. And in the most recent quarter itself, there's a decline of 7% year on year in planned industrial space. So this may impact the demand for soil build itself because soil builds projects, a lot of them come from the industrial sector. Yeah, next slide. Yeah, so overall, this is our recommendations for the 6 construction companies we cover. For BRC Asia, the steel rebar volume was quite muted. It increased only by about 3% in July and August, and also because of the falling steel prices. We downgrade to neutral for BRC Asia because of the recent share price appreciation. Our target price is unchanged. For Centurion itself, because of their stronger balance sheet, and also because they continue to hold a 45% stake in the REIT itself. Our target price is based on the valuations before dividend in specie distribution, which they are expected to give out in next year's AGM itself. Yeah, so our call is still remains. For Everglory itself, we believe that their next 2 years revenue and PATMI will be supported by their order book, and we do think that they are able to secure new orders following Guthrie's acquisition because Guthrie has a track record of several big projects like Changi Airport T5 as well as the runway projects. So we do think that we do have a buy call on Everglory, target price 81 cents. For Pan United, because of the higher ready-mix concrete volume as mentioned earlier, we do think that it will drive their second half revenue and PATMI growth. For soil build, we downgrade to neutral because of the recent share price appreciation. However, we are still positive on soil build because of their significant order book gives them visibility going forward. And also private industrial contracts awarded also increased by 43% in August. For WeHer-wise, we do think that the second half 2025 revenue and adjusted PATMI will be supported by construction segment's significant order book. Recently, they have won 2 HDB BTO contracts, as well as worker dorm. They have recently increased 20% bed capacity in June, and also expected to increase further by almost 40% bed capacity from fourth quarter this year onwards. Yeah, so overall, this is our course. Next slide, please. Yeah, so I think this is the overall construction universe that we try to keep track of. I also tried to separate it based on the kind of nature of the projects the construction companies take. And for example, general construction, heavy lift, infrastructure, building material, real estate, as well as construction-related engineering and services. So these 6 red boxes are the companies that we cover. Yeah, and also the valuations are there. Overall, their construction companies is trading at an average PE of about 16. And yeah, so I think overall, from the companies we cover, Soybuild is still undervalued, BRC Asia also, as well as Centurion. But Centurion, there's a lot of their earnings in fair value gains. Yeah. Yeah, so that's all for construction quarterly. I'll move on to technical pulse to cover Zane, who is on reservist today. Yeah, next slide. Yeah, so Zane expects a muted performance for most asset classes in November. For the review of October's performance, is kind of a mixed performance. The ETF tracking S&P 500, US Treasury bonds, gold, and Singapore equities is green, whereas those tracking the oil, Bitcoin, and Hang Seng Index fell. The top gainers is ETF tracking gold as well as Singapore equities. Both were up about 3% or more. The losers were down on average 4%. In terms of their current trends, S&P 500, US Treasury bonds, and Singapore equities are in an uptrend. Gold, oil, and Bitcoin Hang Seng Index are in a range consolidation. Heading into November, Zane expects ETF tracking S&P 500, US Treasury bonds, and gold to consolidate sideways. On the other hand, ETFs tracking oil, Bitcoin, and Hang Seng Index are likely to extend their weakness into November. And also Singapore equities could remain as a bright spot with more uptrend expected to continue. Yeah, so that's all from my end. I'll hand over the time to Paul. Thanks.
Yeah, thanks, Iban. So I'll move on to Siong and then Keppel's results. So for Siong's third quarter results, essentially more stores, and then you should expect more growth ahead. Next slide. So for Siong, the results was generally in line, although headline numbers, if you look on the left, earnings was up about 11.9% or 12%. Yeah, you have to strip out, there was a 2.2 million gain on lease. You strip that out, they are growing around 6% in the third quarter. The positive was the revenue line, and there was this jump in same-store sales. So same-store sales are those matured stores, like maybe the old store in Ang Mo Kio and so forth. So usually, the most these stores will sell, their growth is usually at most is 1%. First half was 0.1%, but in the third quarter, it jumped as much as 4.4%. So the reasons given was, of course, the vouchers helped. There was a bit of more dining at home. So there was less dining, because what you do is you look at supermarket sales versus restaurant sales for Singapore as a whole, and then you will notice that supermarket sales jump. So you could attribute maybe there's less dining outside. And the third reason is they are quite strong in Hungry Ghost Festival kind of promotions, and they did well for this particular period. So these were some of the reasons given. In terms of the negative for them, so although gross margins continue to go to record levels, 31.5%, you look on the left, the issue for Siong is largely staff costs. Because of the progressive wage model, progressive wage model for retail, you have to raise the pay for cashiers, then for store or for shop assistants and so forth, which obviously is a good thing, but basically is minimum wages. So that has been increased, and you can notice that it is growing like 17% now, faster than the revenue. So this part will continue to be pressuring the net margins. And So in terms of the outlook, we maintain our forecast. We actually raised our target price because we roll over our earnings to 2026 earnings since 2025 already ending. We peg it to 23 times. There's no magic number, what is the right number, but when we look at the last time they had their strong growth, the PE ratio for Siong was as much as 23 times. This is about 2018 time period. So in terms of the outlook, it will still be robust. So the highlight of the results has been the new stores. So if you look on the left again at the very bottom, they actually grew their footprint about 13% year on year, 11 stores. Yeah, so the pipeline remains robust, but the only thing, the second last bullet point is the margins will be under pressure, net margins, because they announced, I think last month, they announced a new distribution center, a huge one, is like 500 million, the estimated cost. It will complete only in end 2029, but from now to 2029, there's going to be pressure because you have to pay for the lease, regardless whether anything is under construction, but you still have to pay for the lease. There'll be less interest income, because you probably have to drain a lot of cash to pay for this. And if you saw the news in August, there's a extension of the progressive wage model. So progressive wage model, if you look at the numbers, you're at the minimum, there is a 5% growth every year for cashiers, for store assistants, store managers for the next 3 years. And so all this is going to pressure net margins, but the new stores will help support growth. So the footprint we think has grown by 13% and with 2 more new stores. So all this will support 2026 earnings, because new stores, they don't mature so fast, so they will only start to mature, slowly get the crowd in. So all this will contribute to growth in 2026. Next slide. Move on to Keppel. It was a third quarter update. Asset management franchise building momentum. Next slide. So for Keppel's update, very hard to peel out any financials, because they don't really give much financials. They just tell you 9 months grow how much, and then. But anyway, the 9 month they did grow the core profit up 25%. But the 9 months have to be a bit wary, because inside core profit they can add in valuation gains, they can and one-off gains. So that part. So if you look at the more important recurring income, so that actually rose 15% faster than the 7%. We're not sure why, they don't really give color, but I guess it's definitely a positive. So the main thing for us in terms of the highlight of the update was the recurring income accelerated, like we mentioned. The other key highlight for us, as the title of the report suggests, is that the asset management franchise is growing. So the equity raise, which is the higher quality funds under management, because for them, when you look at their slides, they will normally say asset under management or funds under management. That includes leverage, but the purer number to look is the actual equity. So equity raise, the 9 months was very strong, 2.7 billion from 0.7 billion a year ago. But of course, all this also includes some of the equity raised by Keppel DC and the REITs. But essentially, it's still positive because the larger the equity raised, then the more fee income you can collect. The negative was the real estate. Nothing really happened. It was basically all unchanged. So in terms of outlook, we actually raised our target price to as we roll over our valuations to 2026 earnings. For us, 2026 will be a strong year for Keppel. Firstly, operationally, there will be the new power plant. And this new power plant will boost their capacity by 50%. Obviously, this is going to generate earnings growth for them because it's a new power plant in 2026. And then there will be commissioning of as you recall, they have a submarine cable they just completed from Singapore to the US. So they sold 2, and then they will earn operations and maintenance income for these 2. But there's another 3 more that they can be sold. So all this will contribute to earnings. Then the third thing is that this was less emphasized, but it's beginning to grow big. So they call it DSS, or decarbonization and sustainability. But essentially, this is waste to energy projects which they manage, which they are kind of a world leader in it. So the order book in terms of maintenance income and operating income is around 7 billion, they mentioned. So the completion of the huge Hong Kong project will also start to contribute in 2026. So all these three areas will start to contribute to operating earnings. So you should expect growth in 2026. Then at the same time, of course, in the background, the more structural, then you have the assets under management growing. So fee income will grow in 2026, excluding acquisition fees and disposal fees, which is hard to predict. Then at the same time, the cash flows are improving. No, they're still waiting for the 1 billion proceeds from M1. And then there should be more asset monetization, and of course, falling interest rates will also help them reduce their interest expense. And they are still going to pay higher dividends. So they did mention that although the sale of M1 will be a loss on sale, but it won't affect their dividends. So you should expect higher dividends from them also. And of course, there's still that of 500 million share buyback, which they done 90 million. So there's another 410 million of share buybacks to be done. So all this will be supportive for the share price or 2026. Next slide. Next slide. So I'll just move on to our usual weekly update. In terms of some of the key macro news that came out from Singapore, a lot of it was visitor arrivals. So visitor arrivals was a bit soft. But actually pretty resilient considering F1 was shifted from October 25 this year, whereas no last year September. So September this year is obviously going to be weak because we don't have the M1 F1. But the strong Sing dollar is also starting to impact arrivals, especially from ASEAN. But India arrivals was strong in September. RevPAR was down. Again, this is going to be the impact. But commentary from some of the hospitality REITs is that the F1 was actually better than a year ago. So you should expect strong hospitality numbers from all the REITs for the fourth quarter of 25. In terms of some of the banking data, it's actually very robust and positive for the banks. So in September, loans growth continues to grow for almost 7% from 6% last month. And it's across the board, so it's quite even. Deposits was especially strong. There's a lot of liquidity in the system now. That's why in September, the deposits were up 9%. But if you look at the last 12 months, the amount of deposits going to the Singapore banking system is 171 billion. So this is 3 times more than a year ago, September 24. So there's a lot of liquidity. And so although NIMs might come down, but all this liquidity going to CASA will still help the banks. Next slide. So in terms of our tactical views, in terms of the Fed rate decision, it was highlighted by ZE. Of course, he cut, but at the same time, he said, no, not sure December because there's no data coming out because of the shutdown. But from us, our view is that interest rates are coming down. So we still expect more interest rates. Even if we don't cut in December, they're still going to cut in January, or I think the next one is March. But because firstly, even the Federal Reserve acknowledged that their interest rates are restrictive, that means still too tight, or monetary policy. They call it restrictive, but basically it's still too high or too tight. So there's room to cut. And of course, by May of 25, you will have the change in the Fed chairman. And you should expect someone that's willing to cut rates. I think you get a bit of inkling or clue with Steve Myron. So Steve Myron was looking to a 50 basis points cut. So this is quite indicative when the Fed chair comes, he's definitely going to cut even more. And the third thing why we think interest rates coming down is that the US shutdown is only going to slow the economy more than what the Fed forecast. There's also, at the background, there's also a bit of loosening, even though he didn't cut rates. There's a mini QE in the sense that there's a lot of mortgage bonds expiring, a few billion a month, and he's going to take the proceeds and invest it into the treasuries. So this is also going to be loosening. I'm not sure if this is 25 basis point cut, but maybe this is academically, maybe this is like a 10 basis points cut for this in October. Of course, we have the C-Trump meeting. Our view is that this is just a ceasefire. You should expect some U-turns to occur. I know Trump will flare up again. But for us, the key thing is there's dialogue. And Trump said that he's going to China in April. So this is going to be positive. And of course, a C is also coming in the later of the year to China. The real end to any trade war is that if there's no more export restrictions. So we don't see that. And that's why it's more like a ceasefire. Our final comment is, of course, the 5 of the Max 7 reported. It's important for us to monitor this because the whole US market, the whole global market is all about AI. So far, the Mac 5, the profits are up 19%, which is huge, to 128 billion profit in one quarter. And of course, in this result season, everyone was just looking for who's the AI winner, which has shifted from Meta, which is supposed to be winner, now it's gone to Alphabet, like what Serena said. But for us, we are watching the cash flow. So what it means to us is that there's more cash flow, there's more profits, and it can support the higher AI capex. So most of them are still guiding higher capex. Meta especially mentioned meaningfully higher. So we should expect this AI capex spend to still continue. But so far, the big winner right now, at least for last month, was South Korea, which the market went up 20% in 1 month. Some markets take 2 years to hit 20%, but South Korea did it in 1 month. Supported by, of course, a lot of AI memory demand, the HBM because of AI. That actually drive the super rally in South Korean stocks. So in terms of the events coming up, we have Bati here. So any good performance by Bati will, of course, help Singtel share price. We have Spotify, but it will be all about the bank results this week, UOB, DBS, and OCBC. These are some of the events, some of the REIT events before we end the year. Next slide. Nothing much. So just to show you some of the arrivals, most things are flattening. The one that is flattening the most, of course, supposed to be the growth is China, but China growth is not happening. RevPAR is down, but I think this is a bit more seasonal because of the delay in F1. Next slide. The banking system demand and supply is robust. So demand is robust because loans are growing. You can see loans continue to gain momentum. And of course, supply is a lot. There's a lot of deposits coming in. So it's like some record surge after the week 2024. Yeah. Next slide. We had a Wilma analyst briefing, so I just give you some core highlights. The results was strong, about 72% year on year, the core. But because they had to pay the case, that 700, the second bullet point, the 713 million cooking oil fine, so they had to sing a loss. There could be some in the fourth quarter, there could be some paper gains because I think they are raising the stake in Adani. Yeah. But there are still 3 cases pending. There's rice quality case, there's a land confiscation case, there's a biodiesel case. Yeah. So let me just go down to the conclusion. So I think for us, if you want to buy, our preference is like the pure plantation companies. Number one, there's still a bit of uncertainty of the government relations. So who knows what other cases might crop up. So there's still this big overhang on the stock, our preference. And number two, I forgot to put in the slides, but I think dividend might be impacted because they said that this big fine might impact the ability to pay dividends. Although Adani Wilma is a 1 billion gain, but it's all paper gains. It's nothing to do with any cash flow impact. So for us, we're very cautious on Wilma, although the earnings was strong. Yeah. Next slide. The last 3 slides is just update on what happened in October. So October, the market was basically up 3%. For the year, Singapore market is up about 17%. Across the board, I think most sectors got the gains. Healthcare was up, I think mainly because IHH, but that's very illiquid. Next slide. Sorry. On this slide, then on the top is some of the top gainers, small mid-cap stocks. So the big gainers were like IX, MM2, Marco Polo, Riverstone. The losers were all these are Creative, LHN, Clearbridge. The big STI or the large cap gainers were like Keppel, Wilma, and the weakness was like Seatrum, Jardine, or them. This is just for a reference. Next slide. These are some of the asset classes that did well. Tech did well. I think Nasdaq was up and Singapore was up about 2%. So we are holding up. In US dollar terms, Singapore market is up about 23%. Next slide. Move on to this is local currency gains. So of course, South Korea was a superstar. I mean, up 70% this year. The weakest was Hong Kong, Vietnam, and all that. This is all just for your reference. Next slide. In terms of our model portfolio, we were up 3%. I mean, just for reference, it's in line with the market. What put us down was some of the REITs like Prime REIT, but of course it bounced today. But CapitaLand, Ascott, Stone Red REIT, and CLI are the pre-renewal laggard. So all these were the ones that drank. The one that went up was Keppel. For the year, we're up about 37. So this is just for reference. Next slide. Okay, thanks everyone. I think we can move on to Q&A.
Yeah, maybe I'll just take this question first. Since Paul was just talking about the banks, deposits and increasing. So this question is asking any reasons why the bank deposits are increasing even though interest rates are going down. Yeah, it's a good question. So it's both of these are actually quite linked. So it's the reason why the bank deposits have been increasing is because the inflow of foreign capital, right, and all the volatility is happening around the world, especially in the US. A lot of capital is coming out and then they're going into Singapore because Singapore's very well known as the safe haven among in Asia, and especially in ASEAN as well. So a lot of these are coming in. And because of this inflow of funds, deposits that are coming in, the interest rates will go down, right? Because the banks don't have to compete or give that higher interest rate to attract deposits. So it's a bit, two of these are actually quite related. So if bank deposits keep increasing, right, then the interest rates will go down even further. And this has been happening, we are continuing to see it. And like to Paul's point, he was talking about why this is good for the banks, because bank deposits, especially the current accounts, savings accounts, they are the lowest cost of funds for the banks, right? I think they pay only a handful of basis points of cost of the customers, including you, myself, and you as well. So these are almost essentially like free capital for the banks. So the higher this is, this will lower the cost of funds further, and then this will help to sort of buffer that margin compression that we are expected to come in because of the lower interest rates. So loan yields will go down, but cost of funds will go down as well because of the higher deposits. Yeah, so this will help to buffer that NIM compression. And also on top of that, we are seeing the loans growth increase as well, and this will help to increase their net interest income. So all in, I don't think anybody asked it yet, but give a brief, I guess, highlight, outlook on the bank's third quarter earnings. That it will, we expect NIMs will continue to decline, right? But it will not be as steep as the decline in interest rates, and that loans growth will step in to sort of buffer that NIM compression to help net interest income at least maintain relatively stable. And then fee income will come in with the wealth management fees and card fees in order to offset some of the decline in net interest margins and net interest income. And also the bank's provisions are also quite stable. So there's a last step there where we will see provisioning sort of flatten out, right? We have seen it flatten out in the second quarter. The third quarter, it should be quite a similar scenario where they stop stockpiling provisions, right? And this will also help to help their bottom line. Yeah, so that's all for the banks, I think. Yeah, someone's asking, Singapore safe haven funds coming in means something not positive going to happen. It's not really not positive going to happen. I mean, it's really because a lot of volatility is happening. So people want to put their money somewhere safe, right? So that's the reason why we are seeing this. It's really trying to move yourself away from all the uncertainty. It's not that something not positive is going to happen, but it's the uncertainty and volatility. Hope that answers your question. I'll hand it to the rest of my colleagues. Thanks.
Thanks, Glenn. I can take on some questions. Anyone upside on NVIDIA as they expect a potential $500 billion in chip order for the next 2 years? Yeah, I don't think there's further upside because I think their main growth driver now is from the hyperscalers. Recently, when they released their earnings, they are still increasing their capex guidance. For example, Google, they increased their capex for this whole year from capex guidance from 85 billion to 92 billion. So that's about a close to 10% increase in guidance. Meta as well as Microsoft also guided. I think Microsoft guided that next FY26, their capex will be higher than the previous year. Yeah, so this is their main growth driver right now. Going forward, I think 2026, we will see more demand from sovereign countries, for example, from the European Commissions, as well as from the UAE as the Stargate projects carries out. And then I think last but not least, in the longer term, the kind of demand that will come in from NVIDIA will be from as they presented in the GTC conference, physical AI, because as robotics are being used in manufacturing facilities, there will be more demand for NVIDIA's chips. For example, Foxconn, in their latest facility in Houston, US itself, they are trying to deploy humanoid robots to in their manufacturing facilities already. And also demand may come from also mentioned in the GTC conference, demand can also come from 6G. When they build up the 6G network infrastructure, as well as from autonomous vehicles. Yeah, so this some updates on the possible upside for NVIDIA. Yeah. There's a question, anything on WeHer? They recently launched their first bond. Yeah, I think it is for some of their developments on their some projects that's going on. So recently some developments include the setting up of their Fund 3. So Fund 3 is a single asset PBSA that they have in Australia itself. So this Fund 3 will be set up towards the second half of 2027 itself. And I think this morning they also announced that there's a hotel business they are going to set up with Hilton. They will come online next year. That one I still have to check. Yeah, so I haven't talked to them about it, but if anything, I'll update you again. Yeah. But I think for WeHer, the main recurring income for these 2 years will still be from their construction segment as well as the worker dorm segment. Yeah. Yeah, I think that's it from me. I'll hand over the time to my other colleagues. Thanks.
Okay, yeah, thanks. Let me just move on to okay. Let me just move on to AMZN has been dropping lately. Any adverse news regarding this stock? There hasn't been any adverse news. Obviously, the key one is the Collywood IPO, which is apparently the IPO price is trading at I think like 12 times forward, so not particularly expensive. My one possibility is that investors might be switching out from AMZN and then just go into Collywood, because that would be the faster growing part of the business. So will it be a time to buy? Yeah, I think they will probably raise dividends, because right now, okay, why I'm hesitating is that fundamentally nothing has changed. What might happen is that they will lose 25% stake in Collywood, but at the same time they will get a stronger balance sheet, and we think they're probably going to use this stronger balance sheet to pay dividends. Because there is no dividend in specie. So no change in our view. It's just that fundamentally some people might just switch out of AMZN. If I have a big stake in AMZN and then there's an IPO, I might as well just go for the IPO because it's a faster growing part of it. So for Collywood IPO, we think we like it. I mean, because we actually have a buy call on AMZN. It's the fastest growing part of the business. They have a strong pipeline of rooms coming up. I just slipped my mind the exact number, but the one to watch for is the 800 nursing homes that is coming up. Because inside co-living also includes nursing homes, which is farmed out by essentially the Ministry of Health. There's supposed to be an 800 bedder coming out, but I think it's slightly delayed. But that is something to watch for. So we still like the whole co-living space. It sits between service apartment where you need to rent at least 6 months, and of course a hotel. So it's basically a play on rising rents in Singapore, and it's a category that is not well served, because why you want to stay in a co-living is because short notice you can move in conditions. Flexible leasing you can be 1 month, 2 months, whereas you want to stay in a home, you still need 2 years and so forth. Yeah, so that is the whole point on Collywood. can comment on upcoming company. Is it fairly value? Any potential upside? Yeah, I think there's upside in the IPO because at 12 times PE and with the growth that's coming up, they have already a secured pipeline of rooms. Sorry, I'm just slipped my mind the exact pipeline, the numbers. Yeah, but the pipeline will give them at least, I think, 30% growth in the next 2 to 3 years. Yeah, so there's at least a baseline of about 10% in capacity. Yeah, hope that helps. I think there was another question about what is Collywood doing actually. So Collywood is co-living. It's a new category. I mean, co-living probably didn't exist 5 years ago, so it's a new category of space. Where a lot of it are foreigners. So foreigners that's coming here for projects. And students is also very heavy on students. We visited the unit near NTU, I think. There's one unit that is rented out a lot by NTU students. So this also a bit like a student accommodation type concept because in Singapore, as you know, there's no pure student accommodation like in UK and Australia because it's so expensive. So a lot of students also stay in this if they can't get a dorm in the uni. It's a moving condition, flexible. Inside there, some of them will have there's also community. So the good thing about it is that it's not just a single room. They actually hold community events. It's like a mini dorm in a way. You come down, there's activities, there's a shared library, shared canteen. Although they don't serve food, you can bring in. So there's a bit of community concept. So it's that unit that I saw was essentially like a student dorm. Yeah, because it was nearer the uni. Those in Orchard are a bit higher end because they have a inbuilt washing machine. There's even a washing machine inside the unit with fridge. Of course, fridge is and of course everyone has an attached toilet. So yeah, that's the concept. Yeah, for those who want to move in, you can move in immediately. You know, you don't need to set up an electricity line, pay deposit, 2-year deposit, several month deposit to your owner, and need a minimum lease of 1 year. And if you want a HDB room, you know, it's not so the privacy isn't so high compared to this. But of course, these are much pricier. This is like 2,005 to 3,000. Yeah. But most of their occupancy for Collywood is about 97, 98. It's almost full occupancy. Yeah. Okay. Yeah. I hope that answers it. Yeah. Yeah. Sorry, a bit stumbling a bit. Yeah. Hi, Paul. In the Thomson Medical AGM, someone has raised the concern of its high interest costs of almost 60 million compared to his profits from operations and likelihood that he has to raise equity through rights issue. What is your view since target price 74? So, okay. So that's definitely right. So the operating cash flow before interest is about 60 million and their cash flow is 60 million. Partly because this has been a pretty bad year, tough year for them because of the whole issue in Malaysia. And the last 2 years, the Thomson Medical has gone major capex and acquisition. So as you know, they paid almost 300 million for the hospital in Vietnam, and they spent quite a bit on renovation. I just see on mine again, but so all these are very capex heavy, and you only get the cash flows coming up soon. We don't think there's a rights issue coming because Peter Lim owns almost 90%. So we doubt there's a rights issue. Also, secondly, because I think they got access to funding, and thirdly, it's also because they are selling some land. So as you know, their balance sheet is very heavy with the hospitals and also the Johor land. So this year they're going to launch some land, and they could also sell some properties. So I think there is a monetization event for them. So that's why I don't think they want to do a rights. And he already own 90%, so I don't think he wants to do a rights issue himself. So I don't think that will happen. I mean, that's my own view. Looking at investing at stocks which give good dividend and recession proof on a long-term basis, can you recommend some stocks without prejudice? Oh yeah, of course, everything we do, there's no prejudice in anything we do. We are regulated now by MAS anyway. So for us, I think some of the notable ones would be in Singapore for very stable growth. Of course, Siong would be one. They have a very strong stranglehold of grocery spending. So grocery spending is a necessity. They pay about 4% yield, but there is growth for them, maybe high single digit, yeah, at most. Then the second one is, of course, which we always recommend is Fraser Centrepoint Trust. So Fraser Centrepoint Trust is almost like a monopoly in retail. So in Singapore, it's quite unique. All the malls, suburban malls, virtually is a monopoly in a 5 kilometer radius. So you can assume you don't like the mall, so you have to go because there's nothing else for you. So and that's essentially grocery shopping and so forth. Yeah, of course, you can argue with Johor there could be a slight impact, but they are essentially monopoly. So the dividend yields about 5% is quite resilient. Of course, the other one is a Netlink Trust. So Netlink Trust, they are the monopoly on all the fiber cables in Singapore. And they will pay that 5% yield, 5.2, 5.3 dividend yield for the foreseeable future because it's a business trust anyway. So that is another one that will pay not sensitive to the economic. So even if touch wood there's a recession, they will still be able to pay all this. They'll still be able to pay the dividends. I guess Netlink Trust is almost like a pseudo bond, although tagged as an equity. Still good to buy Keppel. Yeah, so we still have a buy call. We raised our target price to 12.20. We think 2026 will be a very strong year operationally, and then if they do manage to monetize more assets, that will be the icing on the cake. So the setup for Keppel for 2026 should be another strong year. What's your take on Siong CEO's high compensation of 7 million given staff cost is a drag since I don't have a right comparison. I never really studied it. Yeah, sorry, I don't really have a good answer for you. I never really studied it. Will he do a worse job if he wasn't paid 7, if he was paid 6 million, would his contribution be less? So I'm not sure, but I don't have a proper study how they get 7, so probably a bit unfair for me to give a right answer. Yeah, so sorry for that. But 20%, of course, far outpacing the growth in the income. Yeah. But I don't have a good answer for you. I never look at how they did their pay structure, which I don't think they actually provide. But the usual test we do is if he was paid 5 million or 6 million, will he still do the same job? Probably yes. Yeah. Okay. You mentioned staff cost is a drag on profit. What's your view? Yeah. You're right. I mean, yeah, that's one. But I got no sorry for that. Yeah. Hi Paul, how is a PSR or research view on DBS research report for STI to 10,000 by 2040? Yeah, we didn't really think much about it. 2040, well, nobody remember, but it's basically like basic arithmetics. Yeah, because you assume Singapore GDP 5%, then you assume the market go up 5%. I didn't really think much about it. I thought it was just basic maths. I think no, so what is the thing goes up 5%, but which are the winners? That's probably the more valuable thing. I can tell you, you'll probably hit 40,000 by 2053 also. Not just yeah, if you extrapolate it, you probably the STI will hit 20,000 by 2053. But what's the value in that? I'm not sure actually. Yeah. So which are the ones that's going to do well? So I also don't know how to answer based on the report. Yeah. The key is which stocks are which rather than telling me it's going to go up every year. Yeah. Well, yeah, but how do I monetize that? Yeah. Your view on Q&M current share price run and outlook. Yeah. So of course the share price run now, if you look, there's a lot of share buybacks, both by the shareholders and by the company. So probably that helped the share price. In terms of our view, acquisition would be the big one. So they did quite a big acquisition in Thailand. That there could be more acquisitions coming up. The one that can really push the stock up for me would be the AI business. That one's a bit of could be a blue sky scenario for them if it works out. Because if you recall, they rolled out this AI software which is being rolled out in 1,000 clinics. And if that works, then that will really take the stock to a different level, because that will be like a software technology play. They haven't given an update, so that's something I'm monitoring. Operationally, second half should be better, because if you recall, the government is giving subsidy on some of the dental procedures. Just slipped my mind. Some of the more like crowning, capping, and so forth. So I think that will help the business too in the fourth quarter. Yeah, so operation is strong, but I think the share ran up, probably a lot of it has been the share buybacks. If you look at the announcements recently. But operation is well, but I just looking for acquisitions and the AI. Yeah. Right now it's probably trading, it's coming close to our target price already. Yeah, Ascott, yeah, sorry, yeah, there's an error there, yeah. Paul, CapitaLand Ascott in your absolute 10 indicates buy rating, still sends, yeah, sorry for that, there is an error, because I think the report only came out today on a Monday, but whereas I did the update on Friday, on Saturday and Sunday, so I missed that part. Yeah, thanks for showing that. Yeah, apologize, we will follow Darren's rating. Yeah, sorry for the error. Okay, I will move on to the rest first, then I will come back again. Yeah, thanks.
Yep, thanks. Let me take on some breaking news that CLI might merge with Mapletree Investment. What will happen to CLI if they merge? Yeah, so this is just a speculation. And it's not the first time that there were news or speculations that these two might merge. But basically, what will happen to CLI? They might benefit because if overall if the whole combined entity will be much larger. Currently, the combined entity, the AUM will be around 200 billion. CLI now is 117. So with size and scale, it might be easier to raise funds in the future. And yeah, with interest rates on the downtrend also, yeah, the ramp up of this raising capital and deploying funds also might be faster if they merge. Yeah, but for now it's still very, very early stages, even if anything were going to happen. It's still mainly speculation for now. Yeah. So yeah, I don't want to comment on whether they will happen or not. Yeah. Thanks. Any update and catalyst for Takraw accumulate or hold? Yeah, so for Takraw with a buy rating. Most recent update is that the beauty tech group just IPO'd. So Takraw, they divested a bit of their stake. They used to own about 9%, so they divested about 2% plus. So they remain about 6% stake that is listed post IPO. So from this transaction, they unlocked about 30 million in value. Yeah, and yeah, not to mention that they still own the shares, a 6% stake post IPO. Yeah, so it's a huge positive for them. Yeah, we will update our numbers after the third quarter results. Yeah, but for now we have a buy call and target price of two. See my mind, $2 something. I can't remember. Apologies. What's your view on AU8U after results? I believe AU8U is CapitaLand China Trust. Yeah, so for CapitaLand China Trust, even though operating performance we see like the tenant sales increase, shopper traffic also, but the rentals for the retail is still flattish. So not much growth there, as well as the fact that they divested the Yuhua thing to the CapitaLand China C REIT. Yeah, so absence of income contribution, as well as the fact that the business parks and logistics properties still not performing that great, negative reversions, and there is some vacancies. So if you ask about future dividends, it's likely that CapitaLand China Trust will still experience some decline in DPU year on year going forward. Yeah. Yeah, I think that's all. I hand over to my colleagues. Thanks.
Yeah, thanks, Darren. Let me take this question here on. Let me try to find it. Sorry. Yeah, it's asking about, should one switch out of expensive Singapore bank stocks and move into Hong Kong cheaper bank stocks listed on SGX like HSBC, BOC, ICBC? And what are my views, even though you don't cover Hong Kong exchange? Yeah, yes, if we know that our response is that we don't cover these Hong Kong banking stocks. But I mean, just briefly, I mean, although we don't cover, I would say that, there's a reason why, these, like in your words, you say Hong Kong cheaper bank stocks. It's really because of the risk and the considerations you must take note of when you are looking at these Hong Kong bank stocks is that they are very different in the sense that they face different regulatory regimes, credit risk and policy risk as well. So the whole environment is very different when you look at Hong Kong stocks because it's very dependent on the China, right? On the Chinese I'll say the whole Chinese environment, China's environment. So if you can, I would say that if you go into the Hong Kong banking stocks, it's a bit more higher risk, right, as compared to the Singapore banking stocks. So there's a reason why the Singapore banks, share price have continued to run up, really because of that, like what I said earlier, right, that flight to safety, and Singapore is like a safe haven. So that's the reason why the Singapore bank stocks have been doing relatively well. Yeah. So that's just my 2 cents. I also take on this question here. It's I think we will all the US team will take on, each of us cover different Mac 7 counters. So I will take the one that I cover first, which is Tesla. So the question is, can you rank Mac 7 stocks performance going forward based on current economics AI scenarios? Yeah, so I covered Tesla. So that's one of the Mac 7 counters. And I'll say Tesla, I guess it's, we have a sell call on Tesla, and I think it's the weakest amongst the Mac 7. It's really running, the performance is, the share price is just running on a bit of like, they call it a meme stock. I think JP Morgan themselves call it a meme stock. Right, so it's not my words, but but I do agree because it's whatever Elon Musk does, the share price will rally, right? So you buy back shares, the share price goes up. He says something on X, right? The share price goes up. Where deliveries come down, right? The share price doesn't move much, right? So it's really it's whatever he does, right? And whatever he says, and then that's where the share price goes. So if you're looking in terms of the fundamentals of the company, it's still a car company. I think there was another question asking, about the non-auto revenue, but I typed it out. So yeah, the non-auto revenue is still very small. It's less than a quarter of their total revenue. So they are still a car company. They're not selling as many cars as they used to. Margins are being compressed, right? Like facing a lot of competition, and they also don't have that tax credit from the government. So no more government help anymore. So a lot of the factors are quite negative for Tesla. If you look at in terms of the AI scenario, their AI is a work in progress, right? Their full self-driving is only in a very small area in California, right? And also their robot, right? I think I saw a recent video of how their robot actually works. It can't really do anything much, right? It's very, very basic. So it's not like, he's going to, I'm pretty sure when Elon says he's going to have a robot army, it's not going to be in the near term. We're looking maybe 10, maybe even 15 years or 5 to 10 years away, right? So as of now, the AI is still really a work in progress. So that's for Tesla. I'll hand it over to the rest of my colleagues to cover the rest of the team, the US team, to cover each of their Mac 7 counters.
Thanks, Glenn. I guess I'll take over. So I guess for Magnificent Seven as a whole, we're definitely seeing a sign of fragmentation. So the ones that are more related to AI, like NVIDIA, Microsoft, Amazon, Meta, and Alphabet, they're extending their lead because they have direct exposure to the AI infrastructure and monetization. But then companies like Apple and Tesla, they're lagging behind. So now the market is really rotating from broad tech exposure. So as long as you're, because previously, as long as you're exposing to tech, you're considered a tech company, and the market generally just rewarded. So now it's rotating from that towards more tangible AI revenue stream. So making the leadership a little bit more narrower and more specialized. So it's definitely shifting from hardware, which is Apple, and consumer technology, to AI infrastructure and software. So Tesla, like Glenn mentioned, because it's not directly related to AI. And Apple would be the same because Apple it does roll out some of the AI initiatives, but compared to their mobile phone competitors, they're definitely lacking in the AI segment, and the killer function that they have is going to be the Smart Siri. It's been delayed to the beginning of 2026, so we haven't seen any convincing sign that they're definitely going to trigger a hardware update cycle soon. So because of that, we think Apple is slightly lagging behind. But then the cloud industry as a general, because I cover Amazon, I guess my other colleagues were chipping as well. So Amazon, Microsoft, and Alphabet, cloud industry is definitely a very unsaturated industry. So now all the three companies, they're still doubling down in their CapEx spending. They're seeing a lot of the backlog coming up. So that means we're still seeing a huge demand coming ahead. So these are the companies that are generally doing better. Yeah, I guess I'll pass it to my other colleagues in case they want to add on something.
Hi, thanks, Helena. I cover for Microsoft, right? So to answer the question first, can you rank Mac 7 stock performance? So to rank Microsoft in terms of AI field, I would personally put Microsoft at the higher end of the AI scenarios moving forward, right? The reason is very clear. They got one product that is very used widely by the globally and community, for example, which is Microsoft Copilot, right? Names that is not that unfamiliar. Enterprise use them, institution as well use them. The usage for Microsoft Copilot has been growing as well, right? And because of this artificial intelligence use, which is clear product, clear market, their business segment, which is Azure, which is for the cloud services, has been growing at 30% plus for the last few quarters. And in fact, those numbers is accelerating. Even in the earnings mentioned call last week, which is, right, the numbers for this Azure growth has been growing at 40%. So it's a new high growth for this Azure, which is already a big numbers for their revenue, but it's still growing. So coming from Microsoft Copilot, which is their AI product, has been affecting Azure in positive direction. And not to mention, it's not only affecting the cloud services business, the Microsoft Copilot as well is affecting their core business segment, which is for productivity, which is for Microsoft 365 product. And because Microsoft Copilot is not only solely on AI product of its own, it's also adding new features for products that Microsoft already have, like Microsoft Word, PowerPoint, Excel. Those products have like embedded AI features included into it, so people use it like side by side, right? And even that has been accelerating the revenue coming from this Microsoft core business as well. So it's undeniable that when it comes to AI, Microsoft is the leader in the AI field. And some additional information is that last week, OpenAI announced that they're going public, and that involved Microsoft as well, because they have a huge stakes, about 27% of the Microsoft in the OpenAI going public. And that is going to positively affect Microsoft in the future. That is because OpenAI has announced that they're going to commit about 250 billion US dollar into Microsoft coming for their cloud services. So Microsoft currently have about 300 billion plus for their backlog, right? The remaining backlog. So you add this 250 billion, which they haven't yet included in their earnings call last week because it's still recent. But if you added that, you got like additional more than 100% in commercial bookings. That's like long term, you look at it, Microsoft is going to benefit a lot from it. So it's the leader when it comes to AI, and there's additional long-term accrual revenue coming forward from this OpenAI as well. So yeah, I would put Microsoft as the higher end when it comes to AI play that you want to buy it from. That is all from me. I will pass over to my colleague to resume this Mac 7 question.
Yeah,
I
thanks
think
for. Oh yeah.
it's okay.
Serena, you go ahead.
Oh, okay,
Oh.
okay, thanks. Okay. I cover digital ads, so I'm gonna put some comment on Alphabet and Meta. I think for Alphabet, I think based on the presentations, we can still see that the cloud demand is still very strong, because currently we can see Alphabet not only be able to monetize the infrastructure like data center, but at the same time, their Gen AI services is actually growing a very strong momentum as well, because this company basically built everything in-house, and then they actually build chips and even have their own LLM, which is Gemini, and because of the search business, they do have a very massive database in order to train their LLM. So I think business strategy wise, and in this AI competition, their business strategy will be more well-rounded. As for Meta, I think the scale of their digital ad business still allows them to have a lot of potential in training their LLM, in this case, which is Llama. But if you really compare between these two companies, which are actually under digital ad company, Meta's revenue definitely is less diversified. So I think this is why when they announce the higher capbacks, it kind of scares the investor a little bit. It's reflected in the share price. But so far, we still see a very strong monetization power. And moving forward, we still see the demand from another side of the story, which is the advertiser, still very strong, because they actually do expect spending momentum around 6% in 2026. And since Meta is still improving the recommendation system to boost the precise ad targeting, I think moving forward, the return will definitely shows in advertisers' spending, so that it will be very useful to boost the ad spending as well, and which will reflected on Meta results. Yeah, thanks very much. I think I'll pass the time to Iqbal. Thanks.
Yeah, just concluding for NVIDIA. Yeah, so I think NVIDIA out of the Mac 7 is the fastest growing now. I think 50% year on year, higher than 50% year on year for the past, I think above 8 to 10 quarters. Yeah, so it's the fastest growing, and valuations wise is only at a slight premium compared to average, about 10 to 20% premium. I do think that it's worth the premium, because NVIDIA's GPU chip is the backbone of the different use cases. For example, there's autonomous vehicles, there's simulations in robotics labs, there's gaming, animations, there's warehouse automation. So there's a lot of use cases for NVIDIA's chips. Yeah, so if you want to buy the backbone of AI, then NVIDIA is the choice for you. Yeah, thanks.
Let's clear up the rest of the question. Do you see any recovery and growth in Seatrium? Is it worth holding, accumulating? Yeah, we never covered Seatrium. Frankly, not a big fan of Seatrium. Firstly, in terms of the execution, the margins has always been, I don't know, below expectations. I'm not sure, because maybe the cost base in Singapore is too high, and the positioning of the stock too is something that we don't really favor. I mean, if you want oil and gas exposure to be, is Seatrium really the way to play oil and gas exposure? Or should we just buy the oil and gas explorers out of the US, rather than have to buy Seatrium? So that's why we never really liked Seatrium. Execution is an issue, and even stock positioning. So that's why for us, is it worth accumulating? For us, is no. I mean, of course, we also don't have any coverage on it. What is your view on the outlook on ComfortDelGro and Olam Group? Yeah, okay. So for ComfortDelGro, there hasn't been any particular news, but I guess two things in the environment that might benefit them is, if you dial back, Comfort has taken on a bit of leverage because of all the acquisitions. So the lower interest rates will benefit them. And secondly, if you look at the next 50 index, where the index where most likely a lot of fund managers under EQDP will be benchmarked, Comfort actually has quite a big share in it. They have like a 5% weightage. So that might benefit them. We think we kind of get our guess is that the next batch of EQDP news flow will probably come in end of November. And if you recall, the last time they actually allocate the stocks, all the small mid-cap stocks did have a run at it. So yeah, for Olam, sometimes Olam for us, I mean, to be blunt about it, it's a bit of a black box. I mean, not sure where the margins are coming on. They have a prop desk too, and they're still very heavily debted stock. There's a lot of leverage on this company, so that's why it's always tough for us to give a proper view. The next thing is just to do an IPO I think it's Olam Agri or Olam OFI, yeah, one of the divisions in London. Yeah, so that's the main catalyst. So sorry, we don't really have a strong view on Olam. Yeah. Bowstate, I think I'll leave it to Darren. Why MM2 went up today? Actually, there's no particular reason. As you know, there's a lot of statutory demands coming up for that. A lot of malls are seeking payment from MM2 for the cinemas of unpaid rent. And also they have a 200 million debt. So you can imagine what the banks are doing now. So, you know, when one creditor start to ask for money, everyone will be lining up, but the banks also will be lining up to ask for money. So I don't see any, I don't know, unless there's some major capital raising, some super white knight coming in, I think it will be quite challenging for MM2. But we're not sure. I mean, the bid-ask spread for MM2 is always quite wide. Any one move is already 50% up. But there's no news. I mean, not that we know. Yeah. Any opinion on Neratel? Yeah, sorry, I don't really looked at it recently. I think the big yeah, we ever since the old management left, I think there's just been the outlook has been declining. Yeah, so sorry, I don't really have any particular views. When is Collivu IPO? The IPO is launching 6th November. Then Thursday. Yeah, sorry, just double check. Yeah, so the listing happens on Thursday. What's your view on Pacific Radiance? Would there be a revised target price? Okay, the only way we will only revise our target price, I think 9.8 cents, is if they can order new vessels. Because the last report that we had was based on the existing vessels that they have, and of course their balance sheet will get stronger and stronger because they're already net cash. But to raise our target price, we need to see them ordering more vessels. So at least there's earnings growth. Otherwise, it will be just the existing vessels. And of course, the shipbuilding. So the growth for 2026 for Pacific Radiance will be renewable or one or two vessels, not the main one or two vessels, and the continued construction of the CTVs. So that will be provide the growth. Apart from that, growth for 2026 will be actually quite limited, unless they order new vessels. Can I draw similarities between Collivu and Centurion Accommodation REIT? Yeah, so Collivu is co-living. So co-living is, like we said, it is between the hotel and the service apartment. So average stay is probably 3 months. Where Centurion Accommodation is mainly student dorms in the UK and Australia, and of course workers dorm in Singapore. The one difference in terms of the way the IPO is done is I think Centurion will have a dividend in specie. I think they're working that out. Whereas Collivu, no. So LHN is selling 35% stake. They're raising 100 million cash. But they're not giving any distribution in specie. I think any distribution for existing LHN shareholders will be probably better dividends. Leading on to the next question. Hi, Paul. How will LHN benefit? Yeah, so LHN will benefit from lower interest expense, and a better balance sheet, a stronger balance sheet. But at the same time, there will be more diluted. There's dilution in Collivu. And like we mentioned before, I'm not sure how. I think investors might shift out of LHN. Some investors might shift out of LHN and just go into Collivu if they have not already done so, because there have been some cornerstone investors anyway. Because if you are an existing shareholder, you don't want to, otherwise you'll be doubling your exposure with Collivu. So you probably take one, either one, and most should probably gonna take Collivu. Berkshire, I don't have any. Leave it to the US team. Any updates on Yoma strategy? I didn't really check recently. So many stocks, right? But I think everyone is watching for the elections. I think it's still being planned, if I'm not mistaken. Please do check on that. The elections. We mentioned this before, but the elections, of course, is not going to be nationwide because there's still a lot of conflicts. But the key thing is you want FDI back into the country, and China could come back if they do hold the elections. Although it is not a nationwide elections, I think that is my the prognosis. But the one thing about Yoma Strategic, you have to admire them in a way, because every horrendous situation has been thrown on them. There's been a coup, a currency collapse more than 50%, a power shutdown, investors pulling out of the country. Not to mention there's also an earthquake thrown at the company, but they still managed to grow the business. So I mean, yeah. So yeah, they've been the most stress-tested company in the last 3 years. Any change in the view on CNMC? No change. Our assumption is 3,008 in terms of our or gold price assumption. So assuming gold price doesn't change, stays around this way, what you should look out for will be the results. So of course the results will be really strong, and we should expect some special dividend coming from them. So they are one mining company that are willing to pay out dividends. So that is the in terms of share price driver, that is something to watch for. But 3008 is our assumption in our model in terms of forecast, the DCF, which we use a 10-year DCF. View on SIA India asking for I don't cover, and Miao Miao has left, so we don't have an airline analyst. So I'm just giving you the very superficial answer. So we never like SIA, we still have a reduce. This doesn't help when Air India is sending a SOS, sending more money. Yeah. Marco Polo has gone recently. Any updated views? Yeah, I think Marco Polo is should do really well, I think, the next 1-2 years, because they are going to order another CSOV. Also CSOV is like a CTV for those who don't know. So it's like a floating hotel for offshore wind. So when you want to build a huge when you want to build all those offshore wind turbines, which are this is like a floating hotel where workers can stay, and they can go on deck to these vessels to maintain and construct. Because right now it's not, they actually have like a elevator and a bridge to go there. Otherwise, right now you actually have to go and then climb up. So it's a day and night kind of vessel compared to the CTV, which is like you ferry people to the platform and back. And so that's one thing. The second thing is oil and gas for OSVs like Pacific, Mako, or even maybe not ASL, because ASL is doing tight budgets. There is a structural tailwind for them, because my view is that it's not only I think it's nothing new. It's not only oil and gas that's doing well. There's offshore that's doing well for them. So Mako will do well, especially that Japan is coming up. The bidding activity might come up next 2027, or end 2026, and then Korea is coming up. So the outlook for Mako is actually quite positive. Any update on Genting? Nothing new. For us, I think it's the same thing that we answered. I think going to be throughout the year. So sorry for those who heard. We are not positive on Genting. Although people think that there could be more dividends, but we mentioned they have a 7 billion budget to spend. Their net cash is 4 billion. So I'm not sure how they're going to pay more dividends. And when the RWS2, it doesn't mean after you build RWS2 there's going to be more people coming to gamble. It's more to extend the license. That's our view. Of course, it makes the aquarium bigger, but I'm not sure the gamblers are going to come back because the aquarium is bigger. And of course, they are losing share to Marina Bay Sands. So that's why we are not positive on Genting structurally and for the medium term. The big game changer is when the whole Sentosa area is going to be redeveloped. That's like, I don't know, 2030. Yeah, then maybe there'll be more the population, the captive population size there will be bigger, then maybe that will help them. But in the meantime, I think we think they're losing competitiveness, and the balance sheet is going to be impacted because they have to spend on this RWS 2.0 to extend their license, essentially. Yeah. Okay, I think we took on most of the questions. Yeah, I apologize. Zane is not in today. And thanks everyone for staying back for so long. And thank you for all your questions. I know sometimes too many questions, some companies we don't really cover that well, so we can't give you really a good answer to them. But anyway, thank you everybody for your time. I hope it was helpful, and thanks again for spending the time with us. And I hope everyone have a wonderful week ahead. Yeah, thank you everybody.